Central banks sit at the center of modern economies, even though most people rarely think about them. Unlike regular banks, central banks do not serve individual customers. Their job is to manage the overall financial system and keep the economy stable. Think of a central bank as the thermostat of an economy. It cannot control the weather outside, but it can try to keep the temperature from getting too hot or too cold. One of the main tools central banks use is interest rates. Interest rates influence how expensive it is to borrow money and how attractive it is to save. When the economy is slowing down, central banks often lower interest rates. This makes loans cheaper, encouraging people to spend and businesses to invest. Here is a real-world example. Imagine a small business owner who wants to open a cafe. If interest rates are low, taking a loan to buy equipment and rent a space is affordable. More cafes open, more people get jobs, and money circulates faster. If interest rates are high, that same loan may be too expensive, and the cafe never opens. Central banks also step in during crises. During the 2008 global financial crisis, banks stopped trusting each other and lending froze. Central banks around the world injected massive amounts of money into the system. They lowered interest rates close to zero and bought financial assets to keep banks alive. Without this intervention, everyday people might not have been able to withdraw money or get paid. Another example is inflation. Inflation means prices are rising over time. A small amount of inflation is normal and even healthy. But if prices rise too fast, people lose purchasing power. Central banks raise interest rates to slow down spending and cool inflation. You can feel this directly in daily life. When interest rates rise, mortgage payments increase, car loans become more expensive, and credit card debt grows faster. People spend less, businesses slow down, and price increases ease. Central banks do not control everything. They cannot fix broken supply chains, stop wars, or instantly create productivity. But they shape the financial conditions that influence nearly every economic decision we make. Understanding central banks helps explain why headlines about interest rates matter so much. It explains why governments, markets, and households all pay close attention to their decisions. In modern economies, central banks quietly guide the flow of money, trying to keep growth steady and crises contained.